They're largely lower. The Japanese market, they look like they're in the bear territory.
I expect that we should be in a position to maintain our earlier guidance.
Markets are taking up the odds of Fed rate cuts very, very sharply higher.
All it's gone from is very expensive to somewhat expensive.
It's indicative of a 4% cut. The first rate's coming up, 400 points lower, 24,300 is where we are at.
We will probably try and see some correction as far as the inflation dynamics out there are concerned.
Post-custom duty reduction, we see a lot of traction coming in for particularly gold jewelry.
Essentially, global factory output has come to a stall.
It's a full bear attack. Buyers are on a complete strike.
When US sneezes, everyone else catches a cold.
The mid-cap and the small-cap space seeing quite a bit of a sharper cut compared to the benchmark indices.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Well, that is the day so far. This is Closing Bell. We are coming to you half an hour early because, of course, the state of markets. Nifty still down 600 points. It's off the lows by quite a bit as well. But this is one of the rare occasions in the recent past, at least, where we started down and, we started 400 points lower. And as we approach the last 2 hours of trade, we're down even more. Usually there is a recovery by this point. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me, my colleagues Reema and Surabhi. Guys, hi.
Hi, good afternoon. What a day, right? I guess every once in a while the market does this just to remind all investors, traders, newbies, oldies that ultimately the market is supreme, right? So I guess they talk about risks in the market and the only risk is the one that you can't forecast or foresee. I don't think about 3 or 4 weeks back, I don't think we were discussing the US recession at all. And that's center stage now.
Yeah, absolutely. And actually, we were talking about a soft landing and
Goldilocks scenario and all of that.
I don't know where Goldilocks is.
She's run away.
But it's that's essentially what's going on. So there's a lot which we've been tracking through the course of the day, and we will continue to. But I think the reason why the market here is also recovering a little bit is essentially because U.S. futures have recovered. So about around 1 o'clock. NASDAQ futures were down 5%. NASDAQ futures right now are down about 3.17%. So there's about a 2% recovery coming through in US futures, which we should put out as an alert at the bottom. And that's the reason why here in India as well, I mean, actually, it's almost tick by tick that we've seen a recovery from the day's lowest point as well. I mean, actually, if you look at the the Nifty, the low is 23,893. Way below the budget day lows, and now we've clawed our way back up and we're at about 24,091. The low on the day of the budget was 24,074 or so. We'll continue to sort of bring in various aspects, but let's get some perspective in. We have Adrian Mowat now joining in, someone who's seen global markets and global cycles for a long time. Adrian, great to have you with us here on the program. Thanks very much for your time. US recession, it's just come up upon us. There is, of course, the yen, which is so much of the talking. I think about 70% of the print space is now being taken up by what's happening with the yen. So where are we at? Is this the start of something, or is this just like one of those knee jerks which we see and the market moves on?
It's more You used the word recession, and we're starting to talk about the risk of a US recession. So why have we suddenly started talking about that? Well, I think there's been 2 data points. One has been a weak PMI, both in the US and globally, and the other one was the labor market data. So you've got job growth at 117,000, but people are increasingly highlighting that some of the seasonal adjustment may not be correct, and perhaps the labor market's even weaker than that decline from expectation of 200,000 job growths a month down to 100,000. And maybe the momentum is being lost in this economy and the risk of a recession is rising. But remember, we're talking about the risk of a recession when the Fed has interest rates at 5.25%. That's the highest level we've seen for almost 2 decades. So the Fed has got an awful lot of firepower if they decide that they need to help the economy. And if the Fed is going to move and cut rates, and we're now looking at the possibility that rates are down by a full 1% this year, with perhaps 2 cuts of 50 basis points each in the next couple of meetings, then equity markets are going to start to look ahead and think, right, okay, well, things are slowing down at the moment, but the central bank is responding. And perhaps some of these cyclicals, some of these non-tech stocks that haven't done well year to date, many have actually fallen, perhaps begin to perform well as the Fed provides help to an economy if this economy is really slowing down.
Adrian, morning, afternoon, and thank you for joining in. So on the subject of Fed, there are some who are now saying that the Fed has waited too long to cut interest rates. Would you concur with that?
I think the Fed has looked at the data, and the data as of now has been a headline inflation rate well above their 2% and a job market that's looked pretty robust. Now, we do know that monetary policy acts with a lag, and the tightening didn't seem to have slowed this economy down at the rate you would have thought it would have, considering that the tightening started in 2022. So, is the Fed a bit behind the curve? Maybe, but I'm not sure anyone else could have done much better.
Adrian, great to be listening into you. Yeah, take that point. I think it was somewhere in the middle of summer, May or June. That's when the data points started weakening on retail sales, consumer confidence, and we had the manufacturing PMI, which was quite bleak. And then finally, this jobs report. But to go back to that point, in terms of what happens from here on, you've seen this tape play out before in far sort of, I think, more difficult circumstances as well in the past. Now, if the Fed starts cutting ahead of the next meeting, and if they start delivering these bazooka cuts, say 50 basis points suddenly, will that help the market, or will that, in fact, spark further panic? What do you forecast for the next couple of weeks?
It's a cut at the September meeting that's not that far away. It may feel like a long time away, considering how quick markets reacting at the moment. And a cut in between meetings, no, I think that would be an incredibly negative signal to the market. It would suggest the Fed knows that things are much worse. I think it would be terrible for market confidence to get an intra-meeting cut. We've got a meeting in September. I think a decisive 50 basis point cut would be very appropriate and would help comfort markets.
Okay, great to get that view, because we had experts from Jefferies and JP Morgan earlier, and they said that maybe they'll cut even before September. So that's why we were wondering whether that will be actually, well received at all by the market, but you've made that clear. Just to go back to the point on Japan, so what's happening simultaneously is that you've got the US all set to cut, you've got Japan, hiking rates, the yen surging, and it seems to be compounding the whole carry trade situation. What have you made of what's happening there and the sort of the interlinkages between the markets?
So the yen had weakened to almost actually across 160 at one point. It was a good place to borrow. Rates are still zero, and the currency's been weakening. So we're seeing an unwind of that risk trade. Now, part of that unwind was through a catalyst from the central bank, with the Bank of Japan intervening. But I think it's all sort of worked well in terms of markets that were quite extended with the yen oversold, with US tech equities perhaps overbought. And you're just seeing an unwind of risk. And for the yen, I think it will probably overshoot, but then I think it will go back to being a relatively weak currency. I'm not a buyer that the Bank of Japan should be raising rates. I think domestic demand in Japan still remains very weak. I don't believe the Bank of Japan should take the risk of tightening policy at this point. So yen weakness, NASDAQ falling is about risk off. Probably has a bit further to run, but I see this as more a correction in what is still an uptrend in equity markets. and probably still a story of a relatively weak yen.
Right. Got that. So I have a couple of questions on this, Adrian. One, is this actually, there's no way to know, right? Anecdotally we get, when we speak with a lot of market participants, there is unwinding, etc. Do we have a sense of how large this carry is, the carry trade is?
We don't have any data on that. And, often, people don't need to publish what their positions are, particularly in markets like currency markets, where it's very much counterparty to counterparty. The price action will tell us where we are in the unwind. Unfortunately, there isn't any other evidence we can look at.
Okay, so let's say the interest rate is 0.25% in Japan, 5.5% in the US. Say the US gets to a recession. The expectation was that interest rates will fall by about 125 basis points this year. They'll cut by 125 in 2024. And some are saying that the terminal rate, which was supposed to be 3% or slightly above, if this is a recession, it can actually go even lower. The point is, has this rate differential come down enough for the yen to be for the yen to stabilize and stop being such a factor?
So, look, I think there are a couple of things we're talking about here. So, the central bank of the United States cares about the United States, and we can have a debate about what neutral policy is in the US, but I suspect it's somewhere between 2 to 3%. So if the Fed's concern moves to growth and employment, then we should expect the Fed to be cutting rates quite aggressively to move to at least neutral. And perhaps if the economy does go into recession, then they will move below neutral interest rates. That would still give you a positive interest rate differential in favor of the dollar versus the yen. And I think what people will look at with regards to the yen is the robustness of domestic consumption, job creation in Japan, and not be fooled by an inflation rate that's positive primarily due to imported inflation rather than excess demand in the Japanese economy relative to its ability to supply that demand.
Absolutely. Point taken, Adrian. But, not 5% interest rate differential, right? 20 yen, USD JPY falling 20 yen with a 5% interest rate differential is massive, which is essentially what we've had. I think we've had that once in the last 20 years. I think the last one was 98, 99. A great chat as always, Adrian. Appreciate you joining us, and thank you very much. Sorry, you want to come in?
I think with the yen, remember that they've basically been at zero interest rates, and the Fed has been moving its interest rates. So,
absolutely.
Thank you.
Thank you very much, Adrian. Great chat. Appreciate you joining in, and good conversation. 630 points lower is what we have on the Nifty. We're at about 24,100. Marico just released its first quarter numbers. The numbers were flashing just a while back. Mangalam is here with the fine print and how the numbers are looking. I think there's 4% volume growth. Mangalam, take it away.
Well, the reported numbers are largely in line with street expectations because, the company had given their first quarter update itself. So revenues of just shy of 2,700 crores, largely in line with street expectations of 2,675 crores. EBITDA 626 crores. What is the street working with? 631 crores. And net profit at 474 crores, mildly above street expectations of 462 crores as well. Volume growth of 4%, again, in line with 4 to 5% sort of guidance that the company had given. At the same time, the expectations of the street were of that itself. Gross margins at 52.9% is a big positive. Domestic revenue growing at 7.4% is another positive. And the company, while it's ramped up ad expenses year on year, there has been a slight moderation quarter on quarter, but that could largely be on, seasonality factors itself. What's good is the management commentary that has come in. They expect sectoral volume trends to sustain in the improving trajectory. In fact, they are gunning for robust revenue, volume-led growth going forward as well. In fact, they expect a gradual uptick in the growth of their core categories, as we can see at the bottom of the screen as well. Some updates coming in on their growth businesses, which is food and the digital premium personal care verticals. They expect this to be between 20 to 25% of growth rate going forward, with also food and personal care contributing over 25% of sales by FY 2027. Right now, that number is sub 20% itself. Domestic share of foods and premium personal care will expand to 25%. They're on course to deliver double-digit EBITDA margin in Beardo this year, and also a strong operational turnaround in some of the acquisitions that they've made, and expect the consolidated revenue as well as volume trend to continue to move upward, and that's a positive. That explains why the stock, it was already up before the numbers, given the tailwinds that we're seeing in the FMCG sector, but good performance, even better commentary has led the stock even further higher, even in a wobbly market.
Okay, thank you very much for that. Let's get to the other important corporate update. State-owned power finance lender PFC faces corporate governance concerns from independent directors for loans given to the SP Group. Nisha joins in with the exclusive details. Nisha.
Thanks for that. Yes, sources who are directly involved in this particular matter have shared with CNBC-TV18 that the independent directors of Power Finance Corporation have raised concerns over the company's loan given to Shapoorji Pallonji Group. Now, the directors have raised questions on the loan given to infrastructure business, especially being non-core to PFC, which is purely an energy or a power sector lender. Directors are also concerned as the loan was given to avert default to foreign lenders by SP Group, is what we gather from sources with direct knowledge. It is to be noted that tomorrow is PFC's board meeting on results, and we do gather that some of the independent directors who have raised concerns are likely to raise this particular issue in the board meet of PFC. We also gather that PFC had recently approved a loan of close to 20,000 crore rupees for the infra segment of Shapoorji Pallonji Group. And we are also privy to the loan terms, which are also the terms which the independent directors have raised questions on. First, the loan is backed by a collateral of a land parcel in Mumbai, and it covers only the collateral exposure of 1.75 times of the loan amount. Earlier, they were considering Tata Sons shares owned by SP Group as collateral, which is not the case right now. And also, the loan term includes a moratorium on the principal payment by SP Group for 4 years. All these questions have been posed to Power Finance Corporation by CNBC-TV18, and they have not offered any comment on this. Tomorrow is going to be crucial on independent directors really raising these corporate governance concerns on a specific loan approval to Shapoorji Pallonji Group by Power Finance Corporation, is what we gather.
Okay, all right, Nisha, we got that. Thank you very much for that story. Need to take a break on that note. We'll come back on the other side and bring in Rohit Srivastava. Let's put a technical spin on this as well. With markets collapsing the way they are, how should you be looking at your trades, your near-term investments? We get some conversations going with Rohit in just a bit. Welcome back. So we are still looking at a cut of about 600 odd points, 630 to be precise. 24,000 is being held on to. The only green in the market has been few names from the FMCG space. So your Lever, Nestle, Britannia, Tata Consumer. That's about it. The rest of the market continues to reel under pressure. Rohit Srivastava, as promised, is with us. Rohit, every once in a while, when I think people think that the bulls are invincible, the market comes up with the lesson. It's been a pretty harsh one over the last, I think, 2 trading sessions. What have you made of the sell-off? And at a time like this, I mean, should you just go with, let's go by that traditional wisdom that's swept the market for the last 12 months? Or is it better to stand back and let the global picture settle?
No, I think it's time to step in. Today is an oversold market. We use this proprietary indicator known as the momentum swing, which is there on our strike platform, and it's reading at 2% right now. What that means is that 98% of stocks are showing negative momentum. So when we actually see 98% of stocks showing negative momentum, that's the day to consider buying. All you need to do is just be watchful of where the downward momentum wanes a little bit. We are seeing that now. I think at the end of the day, slight bounce from the lows, initial signs of reversal. We may see some more tomorrow, and so this is the time really to step in, because when there's, like they say, when there's blood on the street, it's time to get in, and you have to always like it if you're on the bullish side to get these moments for the good trades, because the investors will remain buy on hold. We haven't really broken either the 40-day, 50-day averages to say that the investment environment has been tarnished. So it's essentially the traders who take a hit in this kind of volatility. But the volatility provides us with this opportunity. So I think we are in that extreme oversold state, not just on the short-term Nifty, but also on a lot of the concern points, right? If we talk about, say, the Japanese yen, the USD JPY, the daily RSI essentially hit around 11 to 12 today. Extremely low reading. Now, these readings, happen once in many, many years. In some cases, sometimes in a decade or two. And when you see that kind of an extreme reading, you feel that, yeah, all panic has probably set in. So I would expect the dollar yen also to bounce back sharply from here in the coming days, which would sort of ease all this yen carry trade pressure that we are really seeing do the rounds in the market, and probably that's the bigger scare than the recession talk. I don't know which one it is. Is it this one or is it that one? The two have happened so closely that we are confused what is driving down the market. But simple thing, if you're this oversold, you should step in and buy. That's the underlying theme. And no, some of these markets are also not very overvalued. Like I just checked on the Nikkei, the PE ratio there is down to some 12 or something now. That's pretty low, compared to even us. So not a level at which you would be selling Japan.
So let's get straight to the point then, Rohit. If the markets are oversold and this is a good time to come in and buy, what's a relatively space, sector or a theme or a stocks that you would recommend to buy now?
No, so there's safe and there is trend, right? If the trend is not broken, you'd want to be in the strongest areas, and then there is the safe areas. I think the safety has already been proven in places like pharma and FMCG, which are probably down the least today. So that's always the defense. But I do prefer pharma over FMCG. So I would say having some pharma stocks, which are also one of the outperforming sectors of the last 6-8 months, is good on the defensive side. But on the other side, you go back to the winning sectors, whether they are, PSU banks. But I would also say private banks, because private banks, from their period of underperformance, if I just look at the Bank Nifty or the Nifty Financial Services Index, they all broke out post the elections from the 1-year congestion zone, and that pretty much signals that financials are on their comeback as things start improving in the next 6 to 8 months, and probably people will front run that idea. And now with the whole idea that interest rates are going to likely come down, something I've been saying for a while, is now more obvious to the street, then you immediately look at interest rate sensitives. So you start with banking, then you will go on to the auto sector, you will go on to the realty sector, and lastly, you would also not miss out on metals that typically benefit in the end from a weak dollar, strong bond market environment.
Got that. Rohit, you're also a big watcher on, apart from the fact that very quickly things have gotten to very oversold, like for example, RSI on the yen, etc. How is the cycle? How would you assess the strength of the upcycle? And it's possible that we get a bit of a sharper slowdown in the US, right? So then some of this stuff will continue to play out. Maybe not the yen, but if the US recession talk continues. So then how does it all pan out?
So there's contradictory data when you actually look at the US. There have been some interesting tweets about it. If you just go back 1 week, you had GDP data which was actually showing over 2% growth. So now you have non-farm payrolls which are showing possibly job losses and an unemployment rate going up. And then you'll go and look at the PMIs which are still at the higher side. So what should we really go by at this point of time? So there are clearly two camps on this. There's the camp that things will go through or stabilize, and then there's the camp that thinks no, a recession has to happen. I'm probably in the first camp, and there's a reason for this. And the reason is that usually when you're in a deflationary environment, like I think everybody's watched the yield curve also over the last 3 recessions, and there are a lot of theories as to why some things have to play out in a particular pattern. I think this pattern was in a deflationary period when you didn't have an inflation problem. So typically when bonds sold off, money was going into equities. So interest rates would be rising as equities would keep rising. The opposite would happen then in a recessionary environment where stocks would fall and money would go into bonds. So there was basically an inverse correlation between the two. Now what we are seeing is more of a direct correlation, which means that as yields go down and bonds rally, stocks also rally together. And this is because of the inflationary environment. So in an inflationary environment, interest rates go up when there's inflation, bonds fall, stocks fall, and you end up getting a scare, right? That is what we saw in 2022-23. Since then, bond yields have been coming off, initially very, very slowly, which is why the recession talk didn't play out or people didn't get so scared. They thought that, yeah, yields are falling, but when they really fall sharply, we are going to get that recession. But I think in an inflationary environment, yields falling essentially a sign that the inflationary pressure is waning. And as interest rates get cut, you see stocks go up further. So you'll actually see more of a direct correlation, which is what we are seeing, I think, since 22, a more direct correlation between bonds and stocks. It may not have been true for the last 2 days because this is where the scare spread with the yen carry trade and so on. But that's only 2 days, right? Taking 2 years into account, there's one correlation, and then there's 2 days where people just got scared that, are we in the worst case scenario? But as rates actually start getting cut, which is now the expectation that people are building in, I sense equities will actually rally and interest rate sensitive sectors do well. In fact, even if you look at the US, just go back 2 weeks back, you'll see there was a rotation out of tech stocks right into the Russell and the US banking index, right? Both of them made new 52-week highs. And that was the rotation again, based on the same idea that, somewhere falling rates are going to spur interest into these sectors. So somebody started to front run those trades. And I think that's what will happen eventually. Once we are past this short-term knee-jerk reaction, as I might call it, you will see that rotation into many other sectors participating, which are impacted by rates.
Rohit, good explanation. Thank you very much for your time. As Rohit said, Rohit's view is that you should step in and start to nibble, right? If you're trading, if you're holding, if you're an investor, then you're holding on and you're looking at, of course, a little bit of damage to the portfolios. But if you're trading, Rohit believes that markets are oversold after 2 days of sharp selling. So 300 points on Friday, and actually we've come off a little bit more, 670 points right now on the Nifty today. We'll take a break. We'll have Deepan Mehta of Elixir Equities join in on the other side. We continue the conversation on markets, and we'll get you a couple of stories as well. Stay tuned.
Welcome back. The Nifty is at 24,050. It's been hovering around this range for the last 2 hours or so, down 670 points on the Nifty. But let's get to some action from Deal Street. Now, our colleague Rachna has gathered from sources about a deal brewing between Aster DM Healthcare and Blackstone. Rachna, it's over to you for more details.
Right, well, yes, what we're picking up from our sources that Aster DM is in advanced talks with Blackstone for what could be the biggest deal in the hospital space. Now, what we've gathered is Blackstone, that had acquired about 72% stake in Care Hospitals, is looking to merge with Aster DM and form a new entity, which will be run by the promoters of Aster DM and working professionals from Blackstone as well as Care Hospitals. This would, together in the newly formed entity, the total bed capacity would be at 10,000 as Aster DM Healthcare has bed capacity of 5,000 currently and Care has roughly about 5,000. So together that would come to about 10,000, making them second, if not the first player in the hospital space after Apollo. But talking about the deal, it gets more interesting because this is not a cash deal, it's a share swap, which means with this deal, Aster DM Healthcare promoters will have stake in the newly formed entity, which will be merged with Care Hospitals, and in return Blackstone will end up having stake in Aster DM Healthcare. Now, this would also mean, now let's look at what this means for the promoters of Aster DM Healthcare, which is Azad Mopin and family, who hold about 42% of stake in Aster DM Healthcare currently. It would mean that they would end up having stake in the newly formed entity, which would result in them cutting their stake in Aster DM Healthcare and giving that stake out to Blackstone. So this is definitely going to be one of the biggest deals in the hospital space, and we'll be looking out for it. In the meantime, we wrote to the companies, but we haven't received a response yet.
Okay, all right, Rachna, thank you very much for that. So there's a big deal if it fructifies in the hospital space. Well, let's move on to another story. This is LIC we are talking about. And we understand that LIC has got 5 priorities it is set on in an agreement with DIPAM, with the government of India, essentially. 5 areas of improvement that LIC is working on. Yash is joining in with details. Yash, over to you.
Well, in the last 1 year, Prashant, we've seen a 50% increase as far as LIC stock price is concerned. That's been acknowledged by institutional investors as well as retail investors. And that has been a result of many regulatory changes which have become supportive. At the same time, changes as far as the business at LIC is concerned. Now, what we've been given to understand is that LIC, along with Government of India, DIPAM, which is the Department of Investment and Public Asset Management, has formed a 5-point strategy when it comes to the kind of improvements in these 5 areas which the government wants to see from LIC's end. LIC is expected to submit a regular report with the government in terms of development progress in these 5 areas. I'll quickly take you through these 5 points which have been spelled out by the government for LIC. First one is its platform DIVE, which is digital innovation and value enhancement. What is this platform expected to do? It's expected to completely digitize processes at LIC, right from onboarding of policyholders to servicing of policies to claims management. It is also expected to increase digital sales, which are close to negligible points at LIC right now. In FY24, digital mix for LIC just stood at about 0.15%. Less than 1% of the new business premium for LIC came through digital channels. So that is expected to get some push because of this new platform. The second one is divestment of real estate and non-core assets. LIC is the 3rd largest real estate owner in the country. Its properties are expected to be between 50 to 60,000 crore rupees. That is expected to see some divestment from the company's end and raising of funds. Also, some non-core assets are expected to be divested. The third one is agency transformation project. LIC recently appointed A.T. Karne for undertaking a digital transformation project. Essentially, this will include training its large agency force to adopt the digital technology which it takes through the DIVE platform. Also, this will increase, the per agent productivity for LIC. So that will be important. The fourth one is on focus on product mix. LIC's focus has been to increase the non-par sales for itself. That's stood at 18% of the total annualized premium equivalent as of 4th quarter. The management has said that for FY25, that number is expected to increase more than 20%. So that is one area of focus for LIC, which will also increase margins for the company. And the fifth and the final one is growth in the market share for LIC. LIC has gained 260 basis points of market share in the total business, but so far that has largely been driven by the group business which it undertakes. Now the focus will be on growing its market share in the individual business as well. These are the 5 points, the progress report expected to be submitted by LIC with the government on a regular basis.
Thank you very much for that. Dipan Mehta is now joining in. Dipan, LIC is a stock that you've always liked, and now there seems to be an action plan to divest its non-core real estate, increase the margins, look at focusing on upping its market share. LIC is great if you got in at a lower price, but at current levels, what would you recommend?
Yeah, Rima, good afternoon and thank you for having me on your show. Disclosure, we and our clients are invested in LIC, and I still believe in the LIC story. If such value unlocking is going to take place, that was not what was factored in by me. My basic premise of suggesting LIC as a good recommendation was on account of its attractive valuation, where it is still at or below its adjusted enterprise value. And a lot of the enterprise value has not yet got captured in the stock prices, which have moved up. So if this particular process were to take place, and real estate was to get revalued and unlocked, then that would mean even further upsides. And despite so much of competition, LIC still remains a very, very significant player. It has been able to maintain or increase its market share, which is quite, I would say, impressive. So we remain positive on LIC, and where flavor of the season is PSU, I think this is one PSU which certainly has very good potential to go up. Having said that, we are invested, so our views are to that extent a bit biased.
You know, the number one volume traded stock right now is PCBL, Philips Carbon Black, once again. It's up, I think it's up 30% from that from the time that we did that interview with Sajeev Goenka. And that's a big mover, almost 400 rupees coming on for Philips Carbon Black. Marico is up 1%, Shakti Pumps is up 5%, there is Devyani which is up 5%, lots of movers now. Sera is up 4%, Lal Pathlabs is up 2%, there's what else? I mean, actually, this is it. This is the big volume-led gains, which are NCL India is up about 4% or so as well. But that's about it. Then you got to go down, but volumes are a bit lacking at this stage. Deepan, what have you done today in terms of any actionables?
No, nothing at all, Prashant, just waiting. So many times we have called for a correction and I've been very cautious on the market, but even on bad news, the market corrects for a few hours and then recovers its lost ground. I don't know whether this time around it is different, but if it is so, then I'm waiting for the very important figure of 22,500 Nifty before I start investing in the stocks which are on my list. So the importance of 22,500, of course, is the 10% correction from 25,000. So 10% correction and beyond that maybe are good levels, especially for companies which are not going to be impacted so much by a slowing economy if and when that takes place.
Deepan, so you still think, you're still holding out for 22,500? You still think it's going to happen?
I don't know. I mean, time will tell, but a 10% correction, is it too much to expect? I mean,
in a post-COVID market, it's a new normal that I don't think any of us has seen before, right? So therefore the question, but otherwise, absolutely not. I mean, a 10% correction is usually termed quite healthy.
We pre-COVID investors and traders have the baggage that markets can 10%.
Yes.
But post-COVID traders don't have that baggage, so they can buy fearlessly.
I agree. I mean, sometimes we do become hostages of the wisdoms of the past, right? But I don't think maybe that's not such a bad thing, because I think this is a very interesting phase that the market is in. No one has seen a time correction, the post-COVID investors, or a massive price drop. So let's see how this one plays out. But, just to go back to brass tacks, to go back to numbers, for instance, Thermax came out, stocks under a lot of pressure. So just any thoughts over there? Another stock is Samvardhana Motherson. I don't know if in the midst of all this noise, whether you had a chance to look at the corporate development there. I think spending about 230 crores because they want to increase their stake in one of their subsidiaries. I don't know if it's that or something else, because this stock has fallen quite dramatically today. Any thoughts?
No, I think it's corrected because of overall, if the global economy starts to slow down and car sales come under pressure, then certainly the business model is going to get affected, because a lot of the sales are global in nature. And in fact, this particular transaction which they have done is pretty small. The company has had a fabulous track record in acquiring stressed out assets overseas, turning them around, making them more productive. But the size also is massive. And I don't know whether they can get such many more such large acquisitions to keep on growing. At the same time, I think slowing sales across the globe will impact their volume. So they're sitting on good order book position, but end of the day, the volumes have to increase at the OEM level for them to start booking sales, and that may be under a bit of a pressure, looking at the way the news is coming on the macroeconomic front.
By the way, Devyani International, the owner of KFC, Costa Coffee, Pizza Hut, has reported good numbers. Numbers came out earlier today, a revenue growth of about 44%. At the bottom line, the company's turned around from a loss of 1.5 crore in Q1 of FY24. This quarter, they've clocked in a profit of close to about 30 odd crores. So pretty good improvement in the stock in a weak market, is up close to about 3.5%. Dipan, QSRs is still a no-no. Is there anything in Devyani International that you would want to take as a trend, that things may be on the side, on the mend?
See, Rima, it's again a company in which we are invested in, so disclosure from that point of view. And I'm sorry, I haven't gone to the results in detail, but they've done a very big acquisition. I think it was in one of the Thailand or something. So I don't know whether those numbers have got captured, which is why the numbers reported are so impressive, but I need to get more granular about it. But I'm very positive on the long-term prospects, 3 to 5 year prospects of a QSR industry. And these stocks are always going to trade expensive. They are the new FMCG, according to me, and they have a great runway for growth. And we like particularly Devyani in particular, because it rides 3 brands, not like Jubilant, which has only got one particular brand. And I think some of the other brands like KFC, I think there the penetration levels are relatively lower than the pizza business.
Okay, that is Devyani. That's important development beyond markets as well. A lot of violence in Bangladesh, very unfortunate instance. And it seems that the Bangladesh Prime Minister Sheikh Hasina has resigned, and apparently reports are saying that she could have actually fled the country. So beyond markets, there's a lot of other political news in the works as well in our neighborhood, and then of course in the Middle East. But back to the market now. So one area where everybody is looking is FMCG, Dipan, FMCG pharma, right? Now, again, if someone is looking to buy in now, what should be a realistic expectation? Because let's face it, these are not companies that are delivering 10, 12, 15% growth. Within this pack, what would be your preferred pick, and how much is the portfolio weight or allocation that you would give to some of these perceived safe havens like FMCG and pharma?
So should be in FMCG, you need to get a bit more, I think, creative and innovative, and not go for the typical FMCG stocks like the Nestle's and the Dabur and the HULs, the erstwhile giants. The real play in FMCGs and stocks like maybe like a Bikaji or a Varun Beverages or some of the other smaller companies. I thought even Zydus Wellness came with a good set of numbers. So you need to find the specific niches within FMCG which are not mature, where there's a good runway for growth and valuations are reasonable. And that's where I think you'll find the winners. I think just buying the HUL, Dabur, Nestle, Marico is not going to create any great wealth. Sure, they'll protect your portfolio in bad times. When there's a bear market, you won't see as much as a drop in those values. But then, as an investor, you were looking for growth businesses, and these are no longer growth businesses. And you could add ITC to that list as well.
Okay, all right, Deepan, we'll leave it there. Thank you very much for your time. Great speaking with you as always. Appreciate it here on CNBC TV18. So, Deepan Mehta with perspective, 600 points lower, which means that it's a bit of a, we were down about 670, I think, and there's a bit of a recovery, which is once again seemingly set in as we approach the last 30-40 minutes of trade. So 24,100 odd. We take a break. We are back. We'll have Devina Mehra from First Global join in, along with Dinshaw Irani from Helios Mutual Fund on the other side. Stay tuned. Okay, welcome back. You got the market down 600 points, and we're about 24,100. It's been, a red day. Although I have to say that compared to some of the other sort of regional markets in Asia, even in Europe, I mean, it's at par or maybe lesser, 2.5% cut today on the Nifty. Dinshaw Irani is with us from Helios Mutual Fund, and Devina Mehra joins us from First Global. Thank you very much, both of you, Dinshaw and Devina. Great to have you guys on the program. So, Dinshaw, if we can start by asking you, what are the thoughts at Helios today on what's happening, and what is the intel from Helios about what's going on and what is likely to happen from here?
So, Prashant, very good afternoon to you, your viewers, and your team. And thank you for having me on your show. So here's the thing, Prashant. In fact, after March, so basically, what we've been calling out is that the markets are not respecting the fundamentals. Okay, that was the first thing that we called out earlier. From March onwards, the index earnings, the broader indices earnings have been cut by almost 5%. And what did the market do? It was up 11% till Thursday, I believe. So that's how it was. And in fact, June quarter again, the earnings haven't been that great. At best, it's been flat. If you take out the financials, it's negative earnings growth, right? So obviously, valuations is not the only reasons why the market should correct. They were waiting for a negative trigger, and I think the trigger came by way of the yen carry. I mean, 25 bips hike in the interest rates being increased to 25 bips by BOJ is not a small deal at all. I mean, the last time they did that was in 2007. It took almost 7-8 months for Lehman to collapse. So you never know how these winds are blowing after this kind of a up move by the BOJ as such. So basically, this is the trigger that one was waiting for. I'm not calling out a bear market at all. My feeling is it's a correction in the bull market. But the fact is that these corrections can be very savage. And our feel is that this year itself, I mean, this particular calendar year itself, is going to be very volatile and choppy because they're going to be crosswinds all across the globe going forward. So one has to be very careful. And in fact, that's why you'll see that our portfolios are more or less large cap heavy as such. And we're fairly conservative towards the mid caps. We definitely, I mean, away from the mid caps and small caps, whatever new ideas we're finding out, we are investing in those with obviously where the valuations are appealing.
Devina, come in here. What are your thoughts on what we've seen so far, and what's your sense? Beginning something here, or you think it's just a bit of a knee-jerk reaction?
Actually, the reaction, the view is not very different from what I have said on your shows over the last couple of months, which was that in the shorter term, we were expecting some sort of volatility and correction. However, a 1 to 2 year view was positive. So that was broadly what I've been saying for a while. Of course, we've been fully or partly hedged from March. But as I said, even at that time, that while some volatility was expected, it wasn't as if that I was predicting a major crash in the mainstream indices on a sustained basis. Because of that, we were never in cash. So we were always fully invested. Up until the election results, we were fully hedged, and after that, we've been partly hedged. So, that's the way to play it. To go into cash is only when you expect for sure that more or less a crash is going to happen, which is what we expected in early March 2020 before the COVID crash. But that sort of situation doesn't come that often. And in terms of the orientation, not that different from what Dinshaw said and what I have said in the past, that we had cut back very drastically on small caps for the last few quarters itself, even though we knew that in the short term it would hurt relative performance. So the under 5,000 crore companies where we normally have 14, 15, 13 in that range, sometimes 20%. We've been at 5-6% of our portfolio, so as low as that. So we've again been quite skewed towards the large caps because the small caps is, as a category, is where risk lies and where risk management is impossible because neither do stop losses work because those stocks, when they fall like a stone. Yes, there are no exits. Nor can you hedge them because the only hedge available is a nifty put, which doesn't move along with the small caps. So those are the those and other frothy areas, that sudden industries that take off and where there are a lot of thematic funds being launched. Typically, you can take that as a negative indicator that whichever category in terms of small cap, large cap, etc., or industries or themes where there are a number of funds being launched, that's almost always close to the peak of that. But having said that, on a relative basis, India still looks better than most of the world for sure. And I am laughing at all the explainers of the yen carry trade because, as John Kenneth Galbraith said, that financial markets forget history and therefore the bubble pattern just repeats. So the yen trade carries on till Monday it bursts, and that has happened multiple times, right from the time it was the trigger for the Asian crisis, or one of the triggers for the Asian crisis in the late 90s, and then another almost 10 years later, 9 years later. So this is one more time when the yen carry trade has exploded.
So Devina, are you a believer that a recession is coming in the US? Because I think there was one more rule, that SAHM rule, which got triggered today. And it's apparently been giving, the right call since 1965. So are you a believer in that, that the US is entering into a recession, a hard landing?
It's difficult to say just now because, if you read the daily commentaries for whole of last week, again, this is like cause for some amusement for me because on Wednesday after the FOMC meeting, the markets rallied and everybody had one nice little explanation as to why that rally was justified. Then Thursday, Friday, when the markets fell again, all the commentators, all the newsletters, all the press had one nice little story about why that had to happen. So this is, as I often say, the exact same set of data and circumstances can be used to justify a market rise or a market fall. Interest rates getting cut, wow, this is great for the market. Interest rates not getting cut, that means that the economy is doing so well. So it is, therefore also the market going up is justified. So it is all, these are all explanations, and unfortunately, I would love it if that were not the case. In most macro indicators, there aren't enough data points to say that that something which has happened in the past will repeat, because there aren't enough data points for them to be statistically significant and for all other things to be equal. And the first time you're really finding a slowdown in the U.S. labor market. So whether it goes into an actual hard landing, it doesn't seem exactly on the cards just now, because the rate cuts are, I think, not that far off, and it's not as if that there is anything disastrous which has happened on the labor market. It is just that it was not so very buoyant, and now it's not so buoyant. So I'm not very negative on the U.S. economy as a whole.
Rima, the rule that you're talking about is the SAM rule.
SAM rule, yeah.
So she's an economist. She is an economist. She's alive, and she used to be with the Fed, and that's where the rule comes from. Yeah. And according to that one, of course, we perhaps may already be in a recession, shallow. It is all kinds, right? So, Dinshaw, come in on what you're doing and what you would be doing. What are the sector preferences, etc.
So today, Prashant, actually going into the budget, we had raised some cash, and fortunately, we didn't invest that cash even after the budget. So we're pretty stable there. I don't think we're in a rush to invest that cash, by the way. We're keeping that cash aside for some untoward event if that happens at all. Plus, what we're doing is that in financials, we continue to be overweight. Frankly, the numbers also are looking okay. They're not that, given the fact that the way things are today, they are looking far better than others who are reporting in the market. So that, and we're not definitely running into safety. We're not going to do that because we don't think you want to park your money in 60, 70 PE stocks with growth rates of 7-8% because I'm sure our economy on a real term does, on a nominal terms does much better than that. So that's why we won't be doing that as such. Consumer is another space that we are pretty overweight on, but not in the FMCG space, like QSRs and all is where we are pretty bullish on, and obviously tourism remains one of our focus areas. Looking at the way it was, I mean, we didn't do it proactively, but what we had done earlier was taken an approval for a large cap, mid cap fund, and we are in the process of timing that entry as such. So let's see how that goes. I think that was pure luck on our part, I suppose, getting the approvals in place at the right time.
Dinshaw, we haven't seen a correction in excess of more than 10%. We've seen the markets fall 3-4% in the last many months. And even today, from our recent high or all-time high of more than 25,000, it's a fall of about 4%. But do you think the current global situation can precipitate a correction of more than 10%?
One thing, Reema, that 4% is for the indices, right? I mean, if you look at the components within or in the small cap and mid cap space, I'm sure you'll see quite a few stocks which are down 20-30% from what they were when the indices were high. So this hides a lot, right? So, and secondly, as I said, we're not calling out a bear market at all. I don't think India, if at all, loses shirt, the others are going to move around without their clothes, I suppose. But that's not going to happen, because India is probably one of the only markets which is going to show a growth going forward. So that way we are fairly insulated. But the fact is that equity as a class may become unattractive going forward. And that's why we believe that you're going to see a very choppy and volatile market going into this year itself. I mean, in fact, probably even if the Fed cuts rates, I don't think that's going to impact equities in a big way as such. So that's why we are where we are today.
Okay, we'll leave it there. Thank you very much for joining us, both of you, Dinshaw and Devina. Appreciate your time here on CNBC-TV18, and we continue to sort of, lean on both of you over the next couple of days as we get through this sort of bit of a down phase in the markets as well. So 24,075 is where the Nifty is now trading at. We'll take a quick commercial break here. We'll come back. As always, we'll get you a quick check on what's happening in dealing rooms on D Street Chatter. And after that, we'll get you some trading ideas as well. Stay tuned. okay. I mean, I think there is another leg down. So it was looking like we'd be down about 600. It's down 675 points now. Nimesh is joining in to run us through what he's picking up from dealing rooms. People he's been speaking with. Nimesh, take it away.
Hi, Prashant. It's a global risk-off and India is facing a brunt of it. It's largely in the broader market stock because that's where the mid-cap and small-cap had relatively outperformed in the last many weeks, and hence you're seeing more pressure in the broader market stocks today. Every pullback in the Nifty got sold into, and that's largely because I understand there is a very large sell basket at a leading FI. So it looks like some bit of selling pressure is there from the larger FIs as well in today's market. Financials has been a big drag. The index is down nearly 2.5%, but within that it's the NBFCs which have fallen more than the private banks. But as far as flows are concerned, that's largely in the private bank and some PSU bank stocks. So that's where the supply seems to be from the larger FIs. I guess there are some, from an India point of view, a couple of indicators to watch out for. The PCR is close to 0.73, 0.74. Normally we've seen the markets tend to bottom out around 0.65 level. So that is one big cue to watch out for. And also the India VIX is something to track very closely. But globally, there are some reports now and maybe indication as well that maybe central banks will come into action. In fact, Chris Wood wrote in his note as well in today morning that maybe an intra-meeting cut by the Fed is very much likely. So any action from central bank will be very important to watch out for. But from a domestic Q point of view, watch out for the PCI, which is close to turning to bottom, and also the India VIX.
Things are getting a little oversold, aren't they? Nimesh, in terms of specific stocks, what's on your list?
Well, Prashant, on a down day, you normally see a lot of pressure in the high beta names. So the first stock is GLF, been a rank outperformer after the quarter one earnings, but now it looks like some bit of selling pressure has emerged. So there is selling pressure and expect high delivery volumes in DLF today. The second stock is M&M Finance. This is interesting. They gave out a monthly update and that was not very strong. So on back of that, you've seen a bit of selling pressure. And interestingly, Morgan Stanley has put out a tactical sell as well on M&M Finance at these levels. So that's why that stock is under pressure today. A couple of names where there is some small delivery-based buying as well. Granules and Sun Pharma both stands out. Well, the stocks are under pressure, largely on back of overall sell-off, but there is accumulation happening in these levels, though small in quantity, but there is delivery-based buying in these two names at larger FIs. And the last name is Bajaj Consumer. That stock is under pressure today, but there is a large block, nearly 2% equity got changed hands. So looks like some disclosures will be quite interesting as far as Bajaj Consumer is concerned.
Okay, thank you very much for that. Airtel will be reporting numbers typically around 4:30 p.m. And this is what we're expecting, about a 2.5% increase in the company's consolidated revenues. Margins are likely to remain stable. Profits could show a big jump, but in the prior quarter, the profits had fallen by close to about 15%. Now, Airtel Africa has already reported numbers. And for the India business, this time, it could be a bit of a non-event because the tariff hike took place about a month back, and that's going to be effective in Q2. So the bulk of that benefit of the 15% tariff hike taken by the industry will boost the company's India business mobile performance in Q2 and Q3 as the benefits flow through. So in that context, this quarter assumes lesser of an importance. But we're still working with about a 3% increase in the company's top line for the India mobile business. Again, margins are likely to remain stable in the absence of that large tariff hike. ARPUs for the company have been slowly, steadily inching up as premiumization takes place. Subscribers move from 2G to 4G, or some people are moving to higher value plans. So ARPUs are likely to inch up, but again, not by a whole lot. According to our poll, ARPUs should go up from 209 to about 212, and the subscriber increase, particularly 5G, will be fairly strong. So that's the expectation from Bharti Airtel this time. Airtel Africa numbers, remember, are already out. So the street largely focuses on the India mobile business and the enterprise business. Honeywell Automation's numbers are on your screen. It's a tepid 3% top line growth, but the EBITDA performance increase has been close to about 28%. The stock is down nearly about 2%, initially skyrocketing and moving up, and then perhaps the 3% revenue growth has dampened some of the expectations. Anand Tandon is now with us on the show. Anand, wanted to get your thoughts on Marico. Numbers are in line, but then there is that Bangladesh element also. Bangladesh contributes about 12% to its overall revenues. To its international business, it contributes about 40-45%. With the social unrest, turmoil taking place in Bangladesh, is it going to be a big impact on Marico? And is that a consideration at all?
So while I wouldn't want to specifically comment only on a company, the fact is obviously, as you pointed out, there is significant or at least substantial revenue coming from that part of the world, and any political issues obviously will make a difference. But the more fundamental issue is that it is the attempt at Marico always has been to get out from the commodity side of the business into a more a higher value add part, and the commodity side is under significant pressure because of the fact that a whole lot of new players have also come in terms of hair oil and in specific coconut hair oil, etc. So from that perspective also, that is going to be a bit of a challenge, because premiumization, while it's a nice word, it is actually what you're really asking is for people to pay more for the same thing repackaged with a little bit of extra pizzazz, just so that you can pay a higher amount. In a situation where we are currently, where at the lower end of the curve, you're not getting too much of consumer demand, that is unlikely to make a major dent. Already the volume growths are fairly anemical. The price growth is essentially where you're going to make your money. That's not going to be happening. So right now, commoditized type players, especially in the FMCG space, will go through a slightly tougher time, I would imagine.
Tata Motors was weak even last week after they came out with their numbers and the JLR volume update or the expectations for Q2 and Q3. And now with the concerns about global growth slowing down, has further dampened Tata Motors, down 7.5%. Is Tata Motors attractive after this near 10% fall in 3-4 days, or is it an avoid?
Again, you're asking for specific recommendations, which I can't do. But if you were to look at the sector as a whole, most of Tata Motors' revenue growths are coming from Land Rover sales. And, while there are some new products in the pipeline, the international market for SUVs and higher-end cars is actually pretty bad. If you see Stellantis' number, which they reported, the US market especially was extremely weak. And most of the other players are also not reporting anything great in terms of volume increases in those markets. So with that as a background, the only thing that seems to be firing for Tata Motors at this stage is the domestic CV. And that market is not necessarily the one that is going to make a major change in the numbers, but on the domestic side, definitely it is a good part. The split in the businesses is a little more attractive. And the other thing that has been driving the stock is the fact that they think that they'll be able to get out of debt and become net cash positive in the next few quarters. So to that extent, it is a little more attractive. But if you were to look at an international comparison, which is what I believe you should do for Tata Motors, you have a Stellantis at three times or less PE. Of course, the E may not be growing there, but you have Tata Motors at, let's say, 7 or 8. So which makes it quite expensive compared to the rest of its peer group.
Okay, not getting into specific stocks then, Anand, what have you made of the global rout today and the fall that we're seeing in the Indian markets? What's the advice to retail shareholders today?
Well, from a trading point of view, I mean, obviously, a sharp fall like the one that we've seen will obviously mean that, you may want to try and pitch for it, especially, for example, in the global markets, the Nikkei fall has been dramatic. I think somebody else on your channel was mentioning that it is now trading at 12 PE and its own historical anemical. Its performance has been nothing to talk about. It is now at a level which it was as the last 4 years moving average kind of thing, and at a valuation which is against a 14 times, it is now 20% lower than that. So valuation wise, also it is looking quite cheap. So the international markets are looking a little more interesting. The domestic market has hardly corrected. A 4% fall after such a major rise is nothing much.
Okay, got that. The market here for now down about 660 odd points or so. Anand, you want to listen to the next one. Indigo, the airline, has announced business class seats from November, and these will be available for 12 routes, and bookings will open on the 6th of August. My colleague Danish Anand caught up with Rahul Bhatia, co-founder of the airline, beginning by asking him whether the airline is on its way to becoming, sort of a full-service airline with business class across all routes eventually. Listen in.
I'll let customers make that judgment.
But from here on, like next 5 years, 10 years down the line, how big will Indigo become?
Well, I think the presentations today said that by 2030 we expect the airline to double in size. And when I say size, it's just not in terms of revenue, but the footprint that we will expand into with the XLRs. We'll broaden our footprint starting next year. And then in 2027, with the launch of the 350s, we'll go further.
So a couple of months back, we saw there was a stake sale by Interglobe, and you mentioned on the stage that you're here to stay. So could you elaborate on that?
No, because when we did the sell down, there was some speculation on our long-term commitment or longer-term commitment to the airline, and I just felt today was an opportunity to let the world know that we are here to stay. Like I said, it was a personal itch back in the 1990s to go do an airline, and that itch has never been more alive and more kicking than it is today, because we just know and feel that there's an enormous opportunity and a responsibility we owe to the country into the future.
So very lastly, Indigo is the biggest airline in India in terms of market share, fleet size and every other thing. Going down further, a few years down the line, what do you think that the government can do to enhance the support for the airline sector? Do you think that there are certain policies that the government needs to change?
You know, these days when you say something good about the government, people think you're glad-handing the government. But I say this with utmost sincerity that at least in my sort of living experience, I haven't seen a more supportive government. They let you get on with their business. They understand the value aviation brings to the country. They're doing everything they can to build infrastructure. And from our point of view, if the infrastructure keeps getting built, airlines will thrive in this country. All airlines will thrive in this country.
Okay, welcome back. Anand is still with us. We got about 8 minutes to go for market close. 660, 670 odd points lower on the Nifty right now. Anand, you heard the sort of Indigo co-founder. Your thoughts on the airline and how would you rate it?
Well, obviously, the business is doing well right now because of the fact that the capacities have fallen in the industry. And more importantly, given the state of production that we have at Boeing, it doesn't look like you're going to get supply of aircrafts coming up anytime soon. And with that, the capacity therefore continues to remain constrained. Look at what Air India has done so far. Their services, if at all, are even worse than what they were when the government was running it. So even privatization and 1 year of work after that has done nothing to actually provide up any build up any kind of competition there. So Indigo pretty much has had a smooth run in terms of a market which is growing and where there is almost no competition available. The competition will slowly come in. I think and some of the new aircrafts for Air India are coming through, but it's still very slow and the addition to the business is quite high. So for now, I think they've got a clean run and they will probably continue to do reasonably well, at least for the foreseeable future.
Okay, counting down to today's close, but let's get you some more opinion. Earlier today, we chatted with Tahir Badshah, CIO, Invesco Mutual Fund, on the manic panic selling that we've seen today. Listen in.
The sort of events shape up over the last few days, and it's obviously difficult to make sense of everything and put the pieces together. There will be, there are different factors which have been affecting different regions, whether you take Japan or US or maybe even emerging markets for that matter. I think as far as the US is concerned, what we read and what we probably still share as a view and probably is a continuation of what we, in a way, expecting that, we will probably try and see some correction as far as the inflation dynamics out there are concerned and some bit of slowing of growth as well. But in the meanwhile, I think what is happening is quite unexpected lines in a way. I would say that because there was this expectation that in the second half of the year, we will probably try and finally see some possibility of rate cuts emerging. We have been taking this view that since a fairly long period of time, while we did in the last conversation mentioned that we've taken some heart in the earnings delivery up until now, and generally corporate earnings in India still being reasonably stable. But obviously we're expecting a fair bit of volatility in the second half, driven by many events. Some of these events which have happened in the last few days are not necessarily what we entirely anticipated, but we were expecting that there would be possibility of volatility coming through in the second half of the year, and that may crimp returns compared to what we have been used to in the past. So yes, you're right that we do not necessarily expect the second half to be as smooth as what the market behavior has been, especially in India in the last 6 to 9 months' time. Again, in the Middle East, we've seen commodity prices, particularly oil, behave reasonably well, in fact, favorably. So again, a departure from what we typically see when there is geopolitical risks. Many parts of the FMCG stroke, consumer durables stroke, value retail, if I were to call it, or consumption at the lower end of the market in general. Those are parts which have actually lagged the overall market in the last almost 24 odd months. So clearly a catch up. There are certain factors, interest rates coming along the way. That has also been a factor which affects these pockets of the market a little more than what it does to the others. So,
okay, that's some market opinion. Anand, any pockets, any themes, any trends from the earnings picture so far in Q1?
I'm sorry, from the what picture?
So earnings, from the earnings, is there any discernible trend for any sector, theme that you'd like to highlight?
Well, given the current state of the market, overall the earnings have been somewhat flattish. Obviously we are getting into a slightly slower year. In fact, considerably slower year this year compared to the year we just had, where you had blockbuster earnings. So this year the earnings are not going to be anything close. And obviously valuations are also significantly higher. The sectors that perhaps have done reasonably better than what they were last year, let's say, have been largely pharma. Somewhat expectedly, I think the interest is returning towards FMCG as well, more as defensives, and the fact that you are expecting that this year the earnings may be better, largely because of the rural demand growth. But other than that, I don't think that there is too much to celebrate. IT is looking up in the stock market. I don't think I see the same kind of growth in the earnings, actually. If you look at most of the other industries, because of the fact that the margins will be slightly lower this year than they were last year, the earnings will remain somewhat subdued, especially where we are talking about commodities as an input. And we are looking at infrastructure as well, which is kind of continuing to grow, but it's unlikely to be able to expand margin. So if you look at all the major sectors that have been driving the growth, most of them will do a little bit worse than what they did, and the defensives will do a little better.
You know, I just want to point out that the CBOE volatility index, the VIX, the World Equity Fear Gauge, that has surged 120, I think 130% in fact. Yeah, 130. At the end of Friday, it was hovering around 21, 22. Right now, the reading is close to 43 on the VIX. So let's see, we're really bracing for what happens next in terms of the US market action. By the way, NASDAQ futures are again down 850 points. So whatever little hope of a recovery was there, I mean, it's looking very, very tentative at this point in time. And Dow futures are down about 700, 680 to be precise. And S&P 500 futures are down about 150. So it looks like the roller coaster could continue. So any final advice, Anand? I mean, the next 1 or 2 days, what should be done? If you're a long-term investor, just go and buy, ignore all the headlines and the noise, or do you think this time is slightly different from what we've seen the last year?
Well, as I said, for the domestic investor, the near term may actually provide you a trader. You may get an opportunity to trade up. I still believe that the valuations haven't corrected enough, but from the near-term price movement, there's been a sharp fall and therefore you could get a bounce. But that's for the near-term trader. For the longer-term investor, if you're really looking at getting in at a good price so that you don't have to worry about the prices, I think you should wait for a little while longer. It is likely, these are typically 2 months of the year where things don't go very well for the equity markets anyway. There are no major triggers that are going to happen except the US elections, which are a few months away. And yes, interest rates in the US will be cut inevitably, as they always do before the presidential election, irrespective of the state of the market. Don't let anybody bother you about that. They will cut interest rates, no question. So with that perspective, I think you are likely to see a revival a little while later. You have enough time to invest. Traders can obviously perhaps time the market even better.
Okay, all right, we'll leave it there. Anand, thank you very much for joining us and appreciate your time here on CNBC-TV18. We end about 670 points lower. There's about 2.7% cut. Bank Nifty ends 2.5% low. We started on the Nifty 400 points down and we sort of piled on losses even from there. 2.5 lower, some 1,300 points down on the Nifty Bank. Actually, let me just take a quick look at sectorally what did the worst today. So on the downside, you basically have the metal index, which was down a full 5%. Real estate as a pack was down 4.6. Small cap index down 4.6, and the PSU bank index, which was down about 4.5% as well. CPSE down about 4.5% as well. I mean, actually, I think it'll be easier to count if anything was up. I don't think there was any sectoral index which actually ended the day higher today. Rima.
Well, just 4 Nifty stocks closed up in the green, and 3 of them were the FMCG names. So HUL, Nestle, Tata Consumer managing to inch up and close up in the green. HDFC Life flat, but with a positive bias. The mid-cap index sinks nearly 2,200 points. 3.6% gone in the mid-cap index, with the advanced decline ratio at 200 stocks advancing to 2,300 stocks declining. That's the nature of the market today. Big slam dunk and a manic Monday. We're going to wrap up on closing bell, but don't go anywhere because market sell-off comes up next.